Chapter 15, Real Estate Investment. This chapter is going to be dealing with the investment analysis and the various types of investment properties that we deal with. I think that it's important to remember that when we're dealing with investors, that investors, unlike home buyers, look at real estate in a different light. They're looking for a return. No emotion, they just buy it because of cash flows in most cases. Most investors not only want a return of their investment, but they also want a return on their investment. So what we're going to talk about today is what are some of the risks that are going to be involved in buying real estate as an investment, and what are some of the things that we can look at to be able to analyze these types of properties. When we're talking about risk, there are going to be two types of risk that we deal with. One risk is dynamic risk. Dynamic risk is a risk that is not insurable. In other words, it's a risk, we're taking a chance. One of the biggest dynamic risk is business risk. And let me explain what business risk is. If I bought an investment property and expecting a certain cash flow, expecting certain rents, then all of a sudden I found that my vacancy was higher than I had anticipated, or my expenses were greater than I anticipated, or that I've got to compete with another unit and my rents start to come down. That's something that I cannot insure against. Also, financial risk. Financial risk is where I'm in the process of buying something and all of a sudden lending becomes extremely difficult. I think we've experienced that quite a bit in recent years. The other type of risk besides dynamic risk is static risk. Now, static risk is a risk that can be insured. You can take out fire insurance, you can take out theft insurance, you can even take out a bond for completion to make sure the project is complete, and if it's not, an insurance policy will pay off. I want to make sure that you know the difference between marketability and liquidity. Everything is marketable, and when I say marketable, what I mean is that everything can be sold at a price, at some price. It may not necessarily be the price that you want, might be more, might be less, but everything can be sold. Liquidity, on the other hand, means selling something and getting your money back. There are a number of alternative investments to real estate. You've got savings accounts, stocks, bonds, and what have you. But when it gets right down to it, when you look at real estate, it has the most opportunity available. And if you look at savings accounts right now in 2014 at 0.5%, what's the point? So when we're looking at real estate, it has a lot of opportunity, and we're going to talk about the various ways of looking at it. I think the first thing to do is, when we're dealing with investment real estate, what are the various rent categories that we deal with? Whether it's going to be a single-family home that we're renting, or a duplex, or if it's an office complex. We have to understand the different techniques in rent. A gross rent is where the tenant pays rent to the landlord, and the landlord pays all of the operating expenses. We find this typically in apartment buildings. A net lease, on the other hand, is where not only does the tenant pay rent, but the tenant oftentimes pays either all or some of the operating expenses, depending on how the lease is designed. We often find this in office buildings and things of that nature. A lot of your landlords will install an expense stop. In other words, some landlords will say, you know what, I'll pay up to a certain amount of expenses, but beyond that, my tenant is going to have to pick up the tab on the rest of it. That's called an expense stop. Also, I think that you need to know the difference between the gross leasing area and the net leasing area. Obviously, the gross building includes common area that everybody can use. The net leasable area, though, is that particular space within a building that somebody's actually leasing. Mortgage financing. I want to talk about that just a little bit, because in most cases, what we've learned is that investment real estate, leveraging is the secret to cash flow. Leveraging is the secret to any kind of return that we get. I've done investment analysis for years and years, and I can tell you, paying cash for an investment property, a rental property, doesn't make sense. If you can finance 80% with a 15-year amortization, I promise you, your yield on your actual investment into the property is probably going to double at least in terms of what that annual yield will be. When you're dealing with investment properties, obviously we're going to need to understand structural knowledge of the properties, roofs, and things like that. But let's go over property expenses and make sure we understand those. Remember, we said that operating expenses are those things that keep the building running. For instance, your fixed expenses, no matter what the occupancy is, your taxes and insurance are going to have to be paid. So that's considered to be a fixed expense. A variable expense, remember, is one that's going to fluctuate with occupancy, maintenance, management, utilities, and things that are tied to rents or incomes coming in. And once again, that reserve for replacement, depending on how new the building is or how old the building is, there'll be a certain percent. It could be anywhere from 3 to 5%. But you're going to want to set money aside to pay for things that break later on. We're going to be talking about a couple of formulas in here coming up and how these are calculated. I think the first formula that I want to talk to you about is going to be the debt service coverage ratio. And let me explain what the debt service coverage ratio is. This is a relationship of your net operating income as it relates to your debt service. And let me say this. When you go down to a bank and you say, I want to borrow some money, the first thing they're going to ask you is, what is your net income? Do you know what this property is going to be throwing off after you pay your expenses? Because I can tell you, they're not going to make you a loan if there's a chance that your mortgage payment is going to exceed your net operating income. They're going to want some cush. This debt service coverage ratio is giving you cush. It's the amount of cush between the actual debt service that you have and your net operating income. Another calculation that you're going to need to understand is your operating expense ratio. Now, I've got to tell you, this is pretty critical too, because the operating expense ratio simply will tell us how smooth the business is running, how smooth are these rental properties being handled. Because if you have a certain amount of effective gross income, there's a certain percentage that you need to be prepared to pay out for expenses. But what you don't want to do is you don't want those expenses to be too high and you don't want them to be too low. And the rule of thumb for a 100-unit apartment complex might be a 40 to 45% operating expense ratio. And if you're hitting about a 60% operating expense ratio, you've probably got a problem somewhere, maybe in management. If you're down around a 30% mark, there's probably some deferred maintenance. Somebody is holding back on something. So I like to go in and analyze and say, where is that operating expense ratio standing? Because that'll tell me how well management has been managing that particular building. Another ratio that you're going to need to know and that's important is going to be your cash break-even ratio. What the cash break-even ratio basically does, it says how much actual gross revenues do I have to come in order for me to pay all of my bills. And so we have to say, okay, what bills do I have? Well, first of all, I've got all of my operating expenses except for the reserves. I also have my mortgage payment. I've got to pay that. So when I look at those things that I've got to pay, the operating expenses and the debt service, those all have to be paid. The cash break-even ratio, I'm looking for an occupancy rate that's going to break me even. In other words, I don't know what my vacancy is at this point. That's why I'm working off of gross income, where I can calculate my vacancy and my occupancy rate to make sure that I'm within the range of what the market's calling for. Another ratio that is going to be important to you is the equity dividend rate. Most investors that I know call this your cash on cash return. And all this simply is a relationship between the cash that you pay out, including closing costs, as it relates to the before-tax cash flow that you have coming into the property. Now, you can also do this before-tax cash flow and also after-tax cash flow, but it's that cash flow after you pay everything as it relates to how much money that you actually put into the property to buy it. We've already talked about the overall cap rate. The overall cap rate is simply the formula, the income capitalization approach. Now, this is going to be important because of the appraiser. The appraiser is going to have to estimate what the value of the property is based on a particular cap rate in the marketplace. And that's about all we have. I've got one other thing that I want to make sure we understand is a sensitivity analysis. A lot of people don't do the sensitivity analysis. A lot of people don't understand it. But all this is, you're taking 2 or 3 or 4 different borrowing alternatives. And you're looking at maybe 10% down, 20% down, 30% down, 30-year, 20-year, 15-year amortizations, and you're doing some combinations. And what you're trying to figure out is looking at the equity dividend rate. Which one is going to give me the greatest yield to the property out of all my selections of borrowing alternatives? That's all I have for Chapter 15. Now what I'd like to do is review with you the important issues of Chapter 15. Risk in investment ownership include business risk, which has to do with cash flow, financial risk, which is income related to debt service, and capital risk, which is reasonable and available financing. Marketability is being able to sell a property at current market value. Liquidity is selling a property and getting your investment back in a fairly short period of time, typically 1 year. A gross lease, the tenant pays rent, landlord pays all the expenses. In a net lease, the tenant pays rent and expenses. In a percentage lease, the tenant pays rent and a kicker based on the gross sales. The landlord can control expenses through an expense stop. Rent concessions allows landlords to negotiate with tenants and their new updates. Tenant upgrades are paid by the tenant over the term of the lease. It's amortized. Simple interest is the interest that compounds on principal balance. The loan constant is your principal and interest payment expressed as a percentage. In a default and a foreclosure where a lease is in place, priority of lease versus mortgage will determine if the lease is honored. In other words, if that lease has been recorded before the mortgage, only the mortgage foreclosing and any liens of lesser priority can be eliminated. Bankruptcy will terminate leases and other agreements, including listing contracts. Debt service coverage ratio is your net income divided by debt service. Your operating expense ratio is your operating expenses divided by the effective gross income. Cash break-even ratio is your operating expenses minus reserves plus your debt service divided by gross income. The equity dividend rate is your cash throw-off divided by equity. The capitalization rate is your net operating income divided by a cap rate to give you value. The sensitivity analysis evaluates various borrowing alternatives that yield the best equity dividend rate for the investor. Remember, NOI minus your debt service gives you cash throw-off. Cash throw-off divided by your equity gives you equity dividend rate. And that's the end of Chapter 15's review.